Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today I'm going to be looking at Starbucks stock and also CVS stock. I've made video analysis of these both in the past, and I'll put those links down in the description. If anybody wants to go back there and look at those, you can see what the numbers kind of look like before the recent earnings disappointments and stock plunges. I think they're both down double digits, maybe both even down more than 15% today. So I thought I'd just put out a quick update video with maybe some new adjustments and maybe some takeaways, lessons for investors from what has happened with these two stocks. And I've been getting a lot of questions about them, so I figured I'd just make a couple quick videos, hopefully. Okay, so let's start with Starbucks. I think it's a little bit easier. They announced disappointing earnings. I think the fast graph reflects some of that disappointment, but maybe not all of it. And the stock was down, double digits. It was down a lot. I can actually look and see what the price is here. So Starbucks is down at $74 now. I think there's kind of two takeaways here. One is just a basic margin of safety thing. My buy prices are usually pretty low. Often people tell me that I think even today someone commented somewhere that Starbucks would probably never get to my buy price. And that's okay. I mean, usually I want my buy prices in theory to have like a 10 to 20% chance of hitting over time. Because I follow a lot of stocks, so I don't need every single stock that I follow to hit a buy price. But when I buy it, I do like, if I can get it, to have a margin of safety there. And it will help prevent against buying too soon or paying too much, as long as the quality's there and you're not buying it when things are like really bad. I view Starbucks situation right now more as a bit of a reset or kind of challenging period, mostly because, at least at this point in time, because of China. So this is a geopolitical thing. It is a Chinese economy thing. They've already expanded into China. So any kind of trouble there is it's in McDonald's is kind of the same type of thing internationally. These businesses and franchises that have expanded internationally that are retail facing, consumer facing businesses, when there's geopolitical tensions and things like that, it can hurt their business. Not only can they maybe not grow very much, but they could actually shrink that part of their business. So it's just a risk that's out there right now. I think we've seen it with enough stocks, enough businesses, and to name a few, Estee Lauder, probably Nike at least a little bit, Tesla, Apple, Starbucks. These are kind of some of the big ones off the top of my head, and none of them have done that great this past year. So I think one of the takeaways from the Starbucks situation is go through your portfolio. And I made a video a while back about why I'm not investing in Chinese stocks, but you can extend that a little bit to businesses who have a lot of business where they're selling in China, in particular. I think they have a lot of extra risk probably, and investors should take that into account. So the new valuation, so earnings, I forget what the earnings were before I changed them, and they might even be coming down, or maybe, I think I went and looked and adjusted this a little bit, but they could be coming down even more for Starbucks. I did not adjust the earnings growth rate expectation. That could be coming down over time as we get more kind of information. But just going with what we have here, like my new buy price, if there's not a recession, is around like $48 a share. If there is more of a recession, then $36 per share. So still 35 to 50% lower than it is now. And I think if you're just looking at like the midpoint of fair value, it's more like $63 a share would be like fair value. So these are with a margin of safety. And I don't know whether the stock will get there, but this recession price is based on the 2008-9 recession. So if there is a recession or if tensions increase with China or the economy there is extra weak, I think it's totally in play. And if you can get that kind of a deal, that's when you want to come in and try to buy it. So those are my new buy prices without going through. You can watch the other videos and I'll go through how I do my analysis and everything. So this is more of like just an update, a quick update. So that's what I think about Starbucks stock right now. Currently, after the move down, it's valued pretty still similarly to the market. So, I mean, it's not super cheap, even though it's well off its highs, even farther than this. So let's look at CVS now. So I've never been like super bullish on CVS. I don't even know if I tracked it for quite a while, but people kept asking me about it, so I started keeping an eye on it. Now I will say, like, when you look at it, it's back here. Look, this like earnings and price pattern makes sense. It's trading at like 20 times earnings, is growing in earnings in the 20s. You have a little bit of a slowdown during the Great Recession. That makes sense. This what looks like over exuberance here, and then what happens is the price starts trading at this big discount to the adjusted earnings, and that's because they had some M&A when they bought Aetna in 2018, and so whenever you get M&A, usually I wait like 3 or 4 years before I would even consider buying a stock after that M&A, but we've had it now. But what you can see is you get a little bit more of like the truth of how it's working out, and it's not working out very good right now. If you go to the basic earnings, which I'm going to use in this valuation this time, you can see when the big acquisitions like took place. So this is the Aetna one. I think they had a couple smaller ones in 2022. So when a business does that, usually it's because they're either trying to defend their market position or they're trying to find new ways to grow. And usually that means they're not growing really great, like organically, like they did in the past, right? The growth starts to slow down. They see it slowing down. Maybe they even could use some of their stock to buy that, although it looks more like things looked like they were trending down with the stock and then they made the purchase. So, sometimes I just kind of, like I said, even if you waited 4 years, it would have got you close to this downturn. But the Medicare stuff on that side, that Humana's dealing with the same thing. I don't think there's going to be a solution for that this year at all. So I don't feel like there's any rush to come and buy CVS. I really think this is, I have a buy price on it and I'll watch it, but it's going to take at least into 2025 before they can adjust, or before they can get more money for Medicare procedures and things like that. So if they can, but it just doesn't look like it's going to happen this year. And economically wise, in terms of like retail and stuff, I didn't look at the exact numbers that they put out, but just macro, that's not like a super growth business right now, and there's definitely competition. So, and we see the same thing happening with like Walgreens stock, which has just been in a decline over the same time period, basically. So it's not really specific to them, but it's not something I would be rushing to buy. Let me see how far down. Okay, this doesn't even have like the dip. So, and Google isn't pulling it up, but last time I checked, it was about $56 per share. So it's down like 50% almost from its peak. Okay, so let's I just entered in $55 because Google's not pulling up the data. But if we use those basic earnings instead of the adjusted earnings, they also have a lot of debt. So I'm treating this like the price is double what it is. That debt is probably the reason why that if you look at the adjusted earnings PE ratio is so low. So if you paid for the debt too, you're actually going to pay double that. So you can imagine this is more like a 15 PE instead of an 8 PE, 15 or 16 PE. And we also have falling earnings now. So these are going to be falling. I think they actually said $7 on the conference call or on the thing. So instead of $8.30, they're looking at $7 this year in earnings. So I did adjust that. So when you adjust for the debt, you adjust for the fall in the earnings that are starting to fall. It just doesn't look super cheap anymore. Yeah, so like a 7 earnings yield. I did keep the growth rate at 6.5% for the earnings growth. Who really knows if they can actually do 6.5%? It's just really kind of a stab in the dark because there's so many moving parts here now. But when I put it all together, if a person kind of forced me to like put a number on it, I would say if we weren't in a recession and we didn't have too much danger, if you weren't worried about that at all, like $50 would be an okay spot to like buy it. I'm using recession metrics right now because I think we could be late cycle. Interest rates are high. They're staying high, it looks like, for a while. So right now, in order to tempt me to buy it, it would probably need to be under like $39 a share, which actually isn't too far off. It's only 30% off. So yeah, maybe a big swoosh down, another bad earnings report that kind of really surprises the market. And if we got like a total freak out, then I might come in and take a stab at it at that point. Because you have a chance that a reversion, like a mean reversion thing, or if it's a recession, they could recover coming out of it. Maybe cost of the labor and things will go down. So yeah, I'm not super. I wouldn't be super excited about buying it, but every now and then something gets like super cheap. I mean, I bought Pfizer like 6 months ago, 5 or 6 months ago. And I wasn't super excited about it, but I went in and bought it anyway because it was super cheap. If we saw something like that, I might be willing to come in and buy it. So those are my numbers. Starbucks, for me, $36 a share, if it recession number, and CVS $38.39 a share is the buy price there. Okay, hopefully you found this useful. If you did, hit the subscribe button. Definitely go watch the other videos. I actually show you how I do like my calculations. They'll probably be very different than what they are now. The Starbucks one probably won't be too much different, just the actual numbers that are there. That was more of like a margin of safety thing. CVS is more trying to account for all this M&A and the disappointing Medicare payments and things like that. So it's it's a little harder to decipher, but I think Starbucks is a little bit more straightforward. That's more of a China thing. And again, these things aren't always like in the control of the company, it's just kind of where they're at and what they're doing and where things aren't working very well in the economy or the global economy. And you kind of want the market to just get really over pessimistic before coming in and buying them, I think. And then hopefully that things can kind of normalize at some point, and then that's how you can make better returns. Okay, hopefully that helped everybody, gave people something to think about with the new stock price plunges, and I'll see everybody later. Bye.